video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and we're back with another weekend's deep dive. There's plenty of new and updated data to share with you today, so I'm going to show you that. I also want to preface this by saying I've been extremely cautious over the past few months. I've been suspecting that we may be at risk of a lower high bounce in the stock market and ultimately rolling over from there. And we are at that inflection point now. We are late enough in this current daily cycle to know that a pullback is coming in the next week or two. And the real question is, what happens after that pullback? Does it bounce and again form a lower high in a failed cycle? If so, we absolutely have confirmed a lower high and the start of a true bear market and we target lower lows. Or under the hood, is it possible that we can move to new all-time highs, invalidate my top call setup, invalidate the whole idea of a bounce to a lower high, and can we just see these markets rip to new price extremes once again? If so, I call that an easy penny environment, since all we need to do is buy the dips in an uptrend. I also want to say this before we dig into the data today and check in on the base case hypothesis of this channel that we've held for about 3 years now. A few of the warning signs, such as the high yield credit spreads, the yield curves, under the hood, those things are actually improving. So I've long been saying when we get there, we need to pay attention, we need to make sure that we don't get my true alarm bells starting to ring, and for a while it looked pretty dicey. But as it stands right now, and as you're going to see as we approach those sections of today's episode, I'm starting to become increasingly optimistic here based on the underlying alarming signals that I track and the fact that they are one by one improving. With that said, risk is still high and we are certainly at an inflection point, but the good news is, thanks to cycle theory, we can set some invalidations, we can know exactly what levels we need to keep an eye on, what levels we need to hold, and then from there, we'll do what we always do, which is get long, get strong, make all the trades public, and see what the market will give out of the upcoming cycle lows. So as always, we're going to run through this thing from the top, kicking things off with the stock market. At the lows, the base case hypothesis was that we were too bearish, we'd have a blow off top to all-time highs and come tumbling down in a global bear market and recession, and that this high, once it's in for the stock market, would likely remain the high as we experience another one of these lost decades, just like we saw in the prior instances, as the oscillator down the bottom resets itself. Fast forward to today. Oh, hang on. A little sneak preview of the top call indicator we've got that we're working on at the moment. Anyway, fast forward to today, and we have had 3 blow-off top angles. We have violated the third and the second angle and confirmed a failed daily cycle. We headed all the way down to the first angle, and now we're at this inflection point right here, because if we are going to bounce to a lower high, okay, and start a true downtrend, just like we saw back here, okay, we get the breakdown, a bounce to a lower high, and then we truly confirm we're in a downtrend that lasts about a year from top to bottom. If that's what's in play at the hard right edge, then now would be roughly about the time to see this start to confirm. And it would look something like this. As I said, we're almost certainly going to get a pullback in the next few weeks. Well, let's say the next 10 trading sessions. We're going to get something like this, a cycle low, and it's out of that cycle low that we'll finally get our answer. If there are new highs left in this market, then that cycle low will hold and we will see the market climb to new highs. And if this cycle is to fail, so we get a day 9 or something left translated daily cycle that comes down and fails the cycle, that will 100% confirm that that was the top, this was the lower high, and therefore we'll be in a downtrend. If you're brand new to this channel and you don't understand the rules of cycle theory, there is a tutorial in the playlist. Go and watch that and then come back and you'll understand what I'm talking about. But for everyone else that tunes in most of the time, you know exactly what I'm talking about, right? We know that cycle low is coming, we know it's going to bounce, and then out of that bounce, that low becomes the hard invalidation. If we see a failed cycle out of this upcoming daily cycle low, then it is over. We are in a bear market and we will have to adjust our posturing towards that. And of course, if we get that cycle low and it resolves to new highs, as I said, then happy days, right? We're still in an uptrend. This bull market's still got some legs and we've got a good track record of catching that. And it should be, in theory, exactly the same as what we saw back here in the yen carry trade unwind when we got the spill, which we got flat and out the way of. Then we got a higher low into a cycle low come in. We got long and we caught most of this move before going flat before Christmas. And notice is exactly the same as what we saw here as well. We got the inversion. I made a video right there, as many of you know, to say it's now or never. We did indeed get the breakout. We caught that breakout and got most of this move as well. So happy days, right? I don't think it's any different to that. I think it just looks bigger at the hard right edge, but structurally, I think it's exactly the same as this yen carry trade unwind We wait for the market to prove to us it wants to have some momentum, and then we can back that trade. And if for some reason this were to fail, then of course that would confirm the top was already in, and that might be the situation we have here. But overall, as we work through this presentation, there's a lot of things occurring under the hood that make me think we are going to get a bounce to new highs, even though that has not been the base case, and the market will still need to prove that to me. For Bitcoin, I'm making the case that we are going to find a weekly cycle low and then get a double out of that weekly cycle low. So far, this has been working pretty well. It did take a little bit longer to flesh out that weekly cycle low than I was expecting, but ultimately, we're well on our way now. We're sitting somewhere around here. And I still have a target of around 150 plus K for this current weekly cycle top, which I expect to form sometime around June or July. So I still remain very bullish on Bitcoin. And in the level 3 member section, we are still going to be continuing to add more and more exposure to Bitcoin and to the crypto related stocks as well. The next part of this hypothesis was that if we were going to get that true bear market and recession, it would have a deflationary component to it. And the reason I've been saying this is anything you do to the M2 rate of change shows up in the inflation data, albeit with a lag. So an updated version of this chart, most of this snapback has shown up in the CPI here, but I still think the real risk is deflation. We've got to have one final drop, a small period of asset price deflation, and then we will get the resumption of inflation much later in life. Lots of people would champion this as an idea, and this is totally invalidated now. And you can see the trend in trueflation is down. This looks suspiciously like a short-term bottom here and a counter-trend wobble. It's not the first counter-trend wobble we've seen in this macro data set, and it's not going to be the last. But as far as I'm concerned, until proven otherwise, we have indeed got continuation of disinflation. We've been seeing this confirmed in the prints, right? We've been seeing the prints for CPI coming colder. For PPI, 2 months in a row now, we've had deflationary PPI month over month. And the same is true of the most recent print, where month over month headline PPI was 0.5% deflationary as well. So the trend is well and truly established, and the old adage in this game of the trend is your friend until it ends is absolutely true. I don't see any reason to be calling for a resumption of inflation at this stage, especially with tariffs. I know a lot of investors think tariffs are inflationary. They're simply not. They are much more like a one-time tax. For inflation to occur, you need multiple back-to-back price increases, and you need that key component, velocity. So as far as the base case hypothesis for inflation goes, I still believe we're on the right side of that. I still believe we're going to be in a strong disinflationary trend for the next few months at the very least, and ultimately, I believe we are going to slip into a short period of asset price deflation. We're well on our way now, and I also have made the observation here that for a long time, people were aggressively attacking this idea. Many people kept saying, I was wrong about this, and there's no way you're getting deflation, and blah, blah, blah. And I haven't heard a peep out of anyone in many, many weeks now. Many, many weeks of pure silence on this idea, which tells me that everyone is now fully aware that, of course, inflation is falling. We also know that GDP is somewhat weaker, although there's a lot of complexity in that data. I don't want to spend too much time on this today, but what I do want to focus on is we keep getting more and more jobs data, and this has never been harder for me to navigate personally. They consistently keep revising this data down, making it at face value seem okay, and then it turns out if you go back in time, it was actually a lot worse than they were letting on. There's many speculations for why this is occurring, but I'm not going to go into that today either. I do want to say this though, the non-farm payrolls have been stronger than expected. We added 177k jobs for the US in March. Meanwhile, the unemployment rate has steadied at 4.2% for the second month in a row, and we've got slightly cooler earnings month over month. However, year over year, we did see a slight uptick. And again, as I kind of alluded to a minute ago, February and March job gains were revised down again by a total of 58k. I think we need to start asking some questions. Why is it they consistently revise the data down? I'll leave that up to you. I also want to point out, I believe that although it's a bit rough, we do still have a downtrend here. So we are adding less and less jobs, and of course we see the unemployment rate continue to tick up. I also am a big fan of these types of charts. This is the U6, which is the 6-month moving average of the unemployment rate. And note what we've got here is a lead-in phase before acceleration. Just like we had a lead-in phase here before it accelerates, a lead-in before acceleration. We see it in all prior instances. Now, the reason I added that little red squiggle at the hard right edge is this chart is a couple of months old. And in the last couple of prints, we have seen something like this. So I'll show you that now. We have dropped from 8% to 7.9 to 7.8% here.
and the line that this is pressed up against here is the 8% line. So I suspect the real curve looks something like this, although I struggle to actually find an updated version of this chart. But the thing that concerns me about this is until it turns around and breaks trend, prints lower lows, then what we actually have here is, I believe, a lead in before acceleration. And remember, the risk happens fast. The accelerative periods happen incredibly quickly. And it's a very similar concept when we move to the Sahm recession rule. We are yet to see another update. We've been printing 0.27 back to back for a couple of prints now. At the hard right edge though, note exactly the same thing is true. We are yet to break structure, we are yet to print a lower low, and thus this could easily still be another lead in before acceleration, just like we see in prior recessions. So the moment we get a lower low here, I will start to be incredibly happy, think we can breathe more sighs of relief that we're going to swerve a recession. But otherwise, particularly if this thing ticks up, it's going to look suspiciously like what we see before we enter a recession every other time. Hence the theme of this, which is things are looking okay, but the risk is still quite high at this current moment in time. And for context, remember, a lot of people parrot this idea that 4.1% is historically low, but 5 out of the last 12 recessions have started with an unemployment rate of 4.1%, and 1 in the 50s started with just 2.6%. So again, lead in before acceleration, much more powerful than trying to pick a number and decide whether or not it's historically low. We know that interest rates remained paused in May's meeting, and right now it seems that we're not even contemplating cutting rates in June either. So I still make the case this is overly restrictive because we're in a disinflationary trend, because labour market deterioration is clearly present. But I think a lot of the reason this is overly restrictive is simply because the yields remain relatively high. I believe when the 10-year yield comes off and move lower below this low at around 3.8%, then we will really start to see the Fed putting some rapid cuts on the table. And herein lies the first piece of hopium, for me at least, right? We've long been tracking the high yield credit spreads, and we said that when these things break out, it can really start to confirm, particularly if it is against a backdrop of breakdowns in the stock market, that we're moving into a risk-off and financially stressed set of conditions. However, since the last weekend's deep dive, we are now back below the breakout level. Now, if you were here 2 weeks ago, you'll know that I was cheering this on. I was really hoping to see this, and I said that if we can get this look back below the trend line, we could probably all breathe quite a large sigh of relief. Now, we can't do that in its entirety just yet, because this could still be a hard retest, a type 3 breakout before it resumes to the upside. But generally speaking, in my experience, it doesn't tend to do things like breakout, retest, resumption. It tends to just break out and go. And that's why once we started to see this swing in place, I started to cheer on the idea that hopefully we could come back down below the breakout level. And that seems to be what we've got for now. So I'm quite happy to see this. And I think if you're bullish and cheering on new stock market highs, this was something you needed to see. And it is here now, which gives me, again, a little bit of hope that we may well be able to hopefully invalidate this setup and see new all-time highs come into the market following the upcoming cycle low, which is really, really nice, because that's a far easier environment to make money in than cheering on a downtrend. I think a lot of people often find this channel for the first time and they think I'm some sort of doomsayer that wants a recession, that is cheering on a recession, when that's absolutely not the case. It's far easier for me to make a lot more money if this market has new highs left in it. But if we are indeed going to enter a big recession and a global bear market, then I certainly don't want to hold through that. As I said though, high yield credit spreads, very encouraging sign, and if we can continue to cheer on a trade in a range below this breakout level, then I think by the time this becomes obvious, we will probably be at new highs for the stock market. So incredibly positive and encouraging signs there. And it's a very similar theme with the 10-2 yield curves. I've long been saying, for anyone that doesn't know, when this thing inverts, when the yield curve inverts, everyone screams recession, they're wrong. When it reverts back above the zero line, everybody screams recession and they're wrong. It's not until we get true acceleration as defined by weekly higher high and higher low closes in the yield spreads, these big accelerative sweeps, are what actually confirm that we are in a true bear market and a downtrend. Now remember, there's still risk here. And let me really illustrate why. I know a lot of people are looking at this V here and saying, well, it's probably a V just like we saw in the C19 era, right? It could be. But if we draw our eyes to this second angle of attack here, this could absolutely be breakdown, retest, resumption. Okay, again, as we get to that cycle low, we'll see cycle failure to confirm it. And structurally, it will look really quite similar to what we saw back here. Okay, so there's certainly still risk here. And I know people love to jump up and down and scream bullish, and it's good for engagement. And then after we eventually make new highs, people can say, I told you so, you should have bought the dip or whatever. But just keep in mind that those people will get away with that until such time as a recession or bear market does show up. And then they will all get completely crushed because they have no idea how to stay unbiased and flexible to all outcomes. Those people that jump up and down and mock people for being cautious or taking some profits or any kind of risk management and damage control, those people, when risk actually happens, normally go completely silent, right? And I can assure you, most of those people are going to disappear completely when eventually this thing comes home to roost. And again, whilst I'm really, really hopeful we can get a confirmation and new highs, okay, and get some trades and see them all push to new price extremes, whilst I really, really want to see that, if this is breakdown, retest, resumption, and we get a look like my yellow squiggle, then will it really be impossible to have seen coming? I don't think so, right? We would have had a blow off top with 3 angles, violated 2 of them, multiple failed daily cycles, and a lower high bounce, right? Technically, this will be super obvious to look at in hindsight. So whilst I'm not cheering it on, I have to be open to this, and I have to continue to be cautious until such time as the market proves to me that it wants new highs. And again, that's exactly the situation we saw in the yen carry trade unwind, right? Flat before the spill, waited for the momentum to return, back to cycle low at a higher low, and didn't see it fail to confirm a trend change, managed to catch this. And then we've done the exact same thing, right? Flat before Christmas, waiting for momentum to return, buy the higher low pullback, and then see if there are new highs left in it. But if there are not, then it is time to get short, and it is only reasonable to expect something like this to occur. To illustrate this point even further, if I grab this fractal here, right, we can put it here. And it's really not that dissimilar, apart from the spill went further down, right? But you can see it's just a bigger one of this back here. Okay, that's what we're doing at the moment, a bigger, more stretched out version of this. So if we are going to form a lower high, this would be the spot to do it. And that's why I started this episode off by saying we have reached major inflection points for the market. So with all that said, if we're going to get a true breakdown, we should expect to see this confirm by giving us one of those accelerative pushes to the upside that is synonymous with true tops coming in and the start of a prolonged bear market. But similarly to the high yield credit spreads, okay, this is not showing a true sweep yet. It is certainly building higher highs and higher lows. And again, I'm still cheering on the idea that this thing is going to break down, okay? But so far, this is not really super soothing to look at, okay? This speaks to one of these sweeps in the middle of unfolding, right as we've gotten back to a potential spot to see a lower high come in and the start of a continued downtrend. Now, if that bearish scenario is on the table and we're going to do this, okay, then it's only reasonable to expect this to really start to sweep to the upside and absolutely confirm that that whole top call back in, I don't know, December, January time was correct, right? The whole trend reversal signals was correct. But again, we have another glimmer of hope here. Whilst objectively, this is not a glimmer of hope, right? We do have a glimmer of hope when we sharpen this yield curve to the 10-year 3-month, which right now does not look at all like an accelerative sweep to the upside, right? Here was the C19, 3 big candles, a huge push, and then a sweep. It was even more sweepy, if that's a word, right? Back in the dot-com bubble in 2000 and in the GFC in 2008. But at the hard right edge, this thing is doing exactly what I'd hoped we would see, which is just chop around and go sideways, okay? Weekly time frame, just chopping around. I said that we could do this indefinitely, and if we did, this would be a piece of evidence to suggest that there potentially is new highs left in this market. So far, in a period of just a couple of weeks, we have gone from some quite alarming signals like the high yield credit spreads breaking out, signaling financially stressed conditions. We've gone from yield curves that were climbing a wall of worry, and at one point even this 10-3, okay, if we go back just a few weeks ago, started to break above the zero line, started to look like it was potentially getting ready to have a push as well and confirm that top signal. But in just a few weeks, we've now, at least by my estimations, got a sigh of relief right here from the 10-3. We've got a major sigh of relief, at least for now, in the form of the high yield credit spreads. The Sahm recession rule looks like it wants to roll over. I just hope we don't see another spike up and more labour market deterioration. But as I showed, generally speaking, it's not looking too alarming just yet. It's certainly teetering on the edge, but it's not too bad. Meanwhile, inflation, we know is coming down, all at a time, I might add, where we have reached a critical inflection point. So now I want to move into the chart section at the end and really zoom in and make sure that we can find some tradable setups. I will continue to add them with public stop loss levels as always. always, and we'll start this off with the S&P 500. So it's almost certainly going to break this trend line into the daily cycle low, which is due around trading day 40, let's say 36 to 40. I'm going to average it at 38, which would be early June. We'll put that somewhere around here. So I expect to see this, okay, a cycle low. And then, as I said, that becomes hard invalidation. If this cycle fails, then that's it. We got the lower high. We're in a downtrend. It's only reasonable to look back at the 22 bear market and expect something like this to play out. And if that low holds, then it's only reasonable for me to expect all-time highs and to continue to see improvement in this macro data set. But it does mean for the next couple of weeks, I kind of have to sit on my hands and do nothing whilst I wait for the highest probability trade setup to get behind. Again, incredibly similar to what happened back here, just a much bigger one. In fact, let's take a good look at this. I really think it's something like this. I think we've got that ABC down. I think we're moving up, daily cycle low, and then it's time to find out if we're moving to new highs or not. So incredibly similar, just much bigger than the yen carry trade unwind, about twice the size. Ultimately, I proved back here that this technique works. Wait for momentum to return, back it with a hard invalidation, and I don't see any reason why we can't use that exact same strategy here going forward. So again, looking for that cycle low, looking to back that low. If you're a level 3 member, you'll get notified in real time as always, and I'll give you the exact levels of my entry and stop loss. For gold, we still seem to be in the process of finding a weekly cycle, so it may be here and it may take another daily cycle. Something I think we should look out for gold is a move back into resistance that rolls over again and rejects at resistance would indicate that this is not the cycle low for the weekly here, and it was going to take another daily cycle to find the weekly, and then of course we could back the weekly and the breakout. And if what we see here is a bounce that shows up in the next few days that goes straight through this trend line, something like this, then I would say that that absolutely is the weekly cycle. But typically speaking, it takes a little longer than this kind of amount of decline here to actually find a weekly cycle low, which makes me lean on the side that we're going to get a counter trend bounce here and then go and find the weekly cycle and go from there. And last but not least, Bitcoin. It looks to me like Bitcoin is top for this current daily cycle and is going to start to head towards that daily cycle low in the early June time frame. I suspect sentiment is probably going to sour as we approach this low. I expect a lot of people are going to be pointing at this and saying it's a lower high, no new all-time high was made, and I suspect bears are going to be jumping up and down and saying I told you so into this cycle low. But similarly to the stock market, once that low is in, we should not be trading below it, right? This low should hold and we should see new all-time highs in the bullish scenario. That for me is also a tradable long. Like I said, if you're a level 3 member, you're going to get notified in real time when I pull the trigger with the exact level for entry and stop loss. And I also expect to continue to add some of these on a pullback like MicroStrategy and the other ones we're holding in the level 3 members section. All the dip buying we did early March during the big spill is starting to look like a very good idea at this moment in time. It's just a question of whether or not the gains can hold. And the Dixie looks like it is getting ready to confirm a new weekly cycle here with a breakout this week. So it'd be really interesting to see if it can do that. That, of course, may well pressure the likes of the stock market, gold and Bitcoin into their cycle lows as we get a counter trend bounce for the Dixie. And so as you can see, wholly speaking, this whole thing is still playing out in real time. This whole thing is still going day by day, step by step in our favor. But we are indeed at a critical inflection point. As I've said a million times, under the hood, some things are improving. The technical kind of alarm signals are improving. Meanwhile, the macro data set's not looking like we're going to be able to avoid a recession at this point. But as ever, we'll stay open to all possible outcomes. Really, all I care about is staying on the right side of the trade. I'm by no means championing a big bear market in a recession. I don't want to see that. I'm not cheering that on. I would love markets to go up and to the right forever because it makes my life much, much easier as a cycle low and dip buying trader to make money. But ultimately, if the market's going to speak, it is my job to listen. So if you're a level 3 member, look out for the members only video I'm going to post for you guys. For everyone else, I hope you found value here today. I hope you'll consider subscribing and following along as we do one of these every single weekend. And until next time, have a great weekend. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a bad